Okay, guys, I am excited, maybe more than any other live class or segment I've done here on Everything Phoenix because this is going to be a master class on the economy, and we're going to come to a conclusion as to really good predictions based on data as to where we might end up towards the end of the year with 2025. So if you're watching the replay, please comment below and let us know your thoughts on this and how accurate you think this is. Now, I'm going to share with you a presentation that I had the good fortune to sit through and from this national economist, if you will, but he's more than that. This guy is extremely talented, and he brought this to us as a private group. And guys, I'm excited to share it with you in a different form and fashion. Okay, so a masterclass on where this is going from inflation to the Fed and to the rates and to the labor markets and so on and so forth, guys. This is going to be a fun one. So you want to stay tuned to the very end of this one, I'm telling you. And the conclusions we're going to draw will be very, I think, interesting, right? And even if you don't agree with them, you still will you'll be so much more informed as to maybe where are the chinks in the armor, and therefore the whole thing's not incorrect. But I like that aspect of, and this is where I think I conclude that to go. But guys, I'm telling you, this is going to be great. Stay with me now. This is a private presentation that was given to a select few agents here in the Phoenix market that hit a certain production threshold throughout the year. And unfortunately, I was able to be part of this group live. And so I'm going to go ahead and share this presentation with you, with me kind of giving you the nuts and bolts of it, if you will. And of course, I won't do as good a job as this gentleman did, but it's going to be pretty darn good because it is fascinating to me. Why? Because I do care about where the market goes, not just for all of my clients and all of our team's clients, but also for the agents on our team and for the fact that I'm a real estate investor and owner of real estate myself. So if I'm going to make a decision as to sell or buy more or hold or whatever it may be, I want to know for myself what the best strategies are and the best timing it possibly could be. So hopefully you're of that same mindset. If you are, we're going to dive in right now. Now, first, we're going to check on just the market conditions really fast, as we always do. Just a quick sampling, and we're going to get into that presentation. So I'm going to share my screen. And of course, we got to share with you where the overall CMI Crawford Market Index currently is at as of yesterday, January 26th. Okay, we're at 90.4. And again, as you know, 90 to 110 is considered a balanced market. Okay, so we are in a balanced market, barely, we're hanging on, but we are much more close to a buyer's market than we are to a seller's market. So this is overall not good for people who own real estate or want to sell. But if you're a buyer, this is telling you right now, you have this window of opportunity. It may not stay like this the rest of the quarter, let alone the year. Maybe it will be, but that's why you're going to watch the rest of this Everything Phoenix live show, because it's going to give you more insight as to what you may want to do. So here we go. That's where we stand. Now, real quick on the local economy, if you look at January 25th up here, the very top of my screen, you can see closings and comparing them so far this month in January of 25 to where we were in 2024. So we better or we worse? Are we off to a better start or a worse start than last year? Y'all kind of have a good memory as to what last year was like around this time. Most of you guys do. And so this gives you some good insight based on data and data alone. So here we go, guys. Close year to date below 1 million in 2024, 25.37. Okay. We are 25.68. We're up 1.2%. More homes have closed below 1 million than, of course, it did this time. Last year, excuse me. Now, 1 million or more, 215 compared to 339. That's a 58% increase in the amount of homes that are luxury properties, right? Between $1 and $5 million selling this January as opposed to last January. $5 million more, the ultra luxury home market, 7 closed last year, 18 this year in the month of January through the 24th of January for both years combined. That's up 157%, guys. And then, of course, total is up 5.6%. So, guys, is there more demand or is there less demand this time of this year than there was last year? Guys, obviously, for Phoenix, Can't speak for other markets across America. For Phoenix, it's not even close. We're at 5.6% in terms of unit count sold. Now, on a side note, guys, really quick, if you don't mind, let me know, where are you listening from? And why are you interested in the Phoenix home market? Why are you watching this show? Hopefully, I'm not going to be boring. Hopefully, I'm going to give you good meat and potatoes, guys. I'm telling you, this is going to be good. You want to stay on for this, okay? The next 20 minutes or so, I'm telling you, you can pop on, pop off, but you're going to want to watch at least the replay if you can't make it the whole time. I'm going to bring the information for you right here. But guys, right now the market is doing better. It feels, because things have been slow in quarter 4 of last year in 2024. It feels like the market is not doing so well. It feels like affordability is out of reach. It feels like the prices have just exploded and it's kind of hard to buy a home. And certainly because of that, the market's going to have to crash here fairly soon and prices are going to have to tumble on down. But is that true? Is that what will happen? Okay, here we go. I'm going to share my screen and go back to it. All right. This illustrates just how much the balance of sales have tipped in favor of the high end compared to this time last year. Obviously, over $1 million is crushing it when you talk about an increase of 58%. Over $5 million is crushing it when you talk about an increase of 157% year over year. Okay, so the market is obviously starting to pick up. You have the green arrows across the suburbs, the top 17 suburbs across the Phoenix area. You can see the green arrows increasing and increasing. Okay, so the market is doing better in terms of demand. Okay, but let's go and focus on this presentation now. Let's see if we can do this and get this dialed in. Okay, so now we're going to take this here. We're going to decrease that. We're going to minimize that. And here we go, guys. 2025 forecast. Now, this is from this gentleman up here in the corner. You can see his name. His name is Barry Habib. This guy's incredibly intelligent. He actually consults some high-level people all across America, corporations, and even the companies that I think make decisions on the bond market and rates and so on and so forth. Right? I don't want to overstep my boundaries when it comes to explaining everything that he does, but it is a lot, and he's at a very high level. Okay, so we had this presentation. I don't have the slides. I don't. But because I felt it was so good, I'm going to bring it to you in this video in terms of screenshots, because I did not have time to recreate all the slides of his presentation, guys. But it's going to be good nonetheless, and we're going to work through this because the information is gold. All right, 2025 forecast. Here we go. Now, let's start with this. The 2024 forecast recap. Okay, this is important to know how good this guy is, okay? No one's perfect in terms of predicting the future, but this guy is going to be one of the best ones to look at if you're wanting to predict the future when it comes to housing market, economic data, etc. Here we go. 2024 forecast recap. Why listen to him? Okay, here's the recap. Home price appreciation across America. Now we're talking the U.S. here, right? Forecast. He forecasted last year 4.5 to 5% year over year appreciation. The actual was 4.5%. So he pretty much predicted that accurately. The 10-year Treasury, okay, forecast 3% to 4.4%. The actual was 3.6 to 4.7%. So pretty darn accurate right there, okay? Excuse me, 30-year fixed rate forecast. These are mortgage rates, right? Mid 5s to high 6s. 6% should unlock, move up buyers. That didn't really happen. That's the one he missed, okay? But did he? The actual was high 5s up to the low 7s for most of the year, okay? As you remember, in September, October, it dipped down in the high 5s for just a hot minute, and then, of course, it went back up. Every time the Fed spoke, Jerome Powell spoke, boom, rates went up, not down, even though he was dropping the federal funds rate, right? Move-up buyers responded as expected. So, guys, he missed it, but did he? Okay, but did he? Here we go. Here's why he says that maybe, after all, he didn't really miss it that much, and here's why. The QCEW is the actual governing body that actually reports job numbers, okay? Now, non-farm payrolls is what comes out when you see the jobs report once a month, at the beginning of the month, okay? This is what comes out, non-farm payrolls, okay? So here we go. Through 2003, quarter 2 to quarter 2, 2024, non-farm payroll survey of 670,000 businesses said they were created 2.5 million jobs. Okay, all right, during that time, that 1 year time frame. Now, after they were corrected after the fact, because this is what happens every single a month and over the course of the year, these job reports get corrected, right? After they were corrected, the QCEW, you can look this up, Google it yourself, came out with 1.25, okay, million jobs, okay, on actual data over 12 million businesses, not 670,000 businesses, okay? Bigger sample size, more accurate data. The actual job report came out at 1.25 in terms of jobs being created. That is a difference of 100,000 jobs per month not being created as reported when the jobs report comes out, which moves the markets up and down. That's not cool. So because of that, did he really miss where rates were going to go? Because he was assuming and predicting there'd be around this 1.25 million jobs being created. So that's interesting, okay? Next one, core PCE. Guys, there's a CPI and there's a PCE. Now we're talking inflation. We are jumping right into inflation, okay? We all know that our economy was affected big time by inflation, right? Our pocketbooks were affected by inflation. Go to the grocery store, get new auto insurance if you can get it. That's a whole other conversation we can have here on this show. Inflation went through the roof, okay? Now, PCE is the one that the Fed actually likes to really watch and pay attention to more than the CPI, okay? Now, in this PCI, it may be significantly overstated, he is claiming. Why? Because it's 2.8% year over year as of November, the PCE, okay? But what makes up the PCE? Okay, shelter is a big part of what makes up the PCE. It is core to that index. What is shelter? Shelter is rent. Shelter is rent rates and what landlords or homeowners might state they would rent their house out for if they were going to jump into the rental market. So it's very interesting how for years and years and decades they have come up with this index score when trying to figure out what the PCE actually is, okay? CoreLogic Rent Index came out at 1.7 year over year, not 2.8. Now, 4.8% PCE minus 1.7% CoreLogic equals a 3.1% overstatement in actual shelter, okay? Now, the reason why this is also not good is because when the government goes around or the PCE, Bureau of Labor Statistics. That's a tongue twister. The Bureau of Labor Statistics, the BLS, right? They go out and they collect this data. When they do it, they actually survey 1/6 of the country. Excuse me. I'll get this out here, guys. Let me put you on here. 1/6 of the country at a time. So effectively, the data is really lagging because you're only getting the information from 1/6 of the country. So somebody you're going to collect that rental shelter information from 1/6 of the country in January, you won't hear from them again until July. This is flawed at its core in terms of how they collect it, but they've been doing this for years, so they just keep doing the same thing over and over again. The Bureau of Labor Statistics, okay? So share my screen, and you can see that at 4.8% in PCE, okay, this is the shelter core, 4.8, which is 18% of it, right? 1.7, CoreLogic is a 3.1% overstatement in shelter, which makes up 18% of the PCE index. See where we're going with this? Based on core weighting of shelter results in an overstatement of 0.5%, okay, because it's only 18% of the PCE. Core PCE should currently be 2.3% without the shelter lag, this 1/6 of the country lag we just talked about, okay? So think about that. Here's the monthly reading of shelter in the PCE. As you can see, from February, March the 23rd, all the way through 23rd, it kind of zigzagging, but it's going down to November of 2024. So PCE shelter, which is 18% of PCE, has been coming down. So what does that mean? That means that they believe that the labor market, we're going to jump this one right in front of it, guys, right here. The labor market forecast actually, oops, sorry. Let me go back to here. Okay, so they believe that there's an overstatement in inflation, that inflation actually should not be at where it is, but actually lower by the end of 2025. I bet you didn't think I was going to say that, but lower because of the overstatement in shelter and the lagging data. Interesting, okay? So that means inflation looking to come down lower than what it really is by the end of the year, okay? Now, let's go to labor market. This is the labor market. This is the unemployment market, okay? You can see right here that fake job postings are becoming a real problem. This is right from the Wall Street Journal. This is not a political statement. This is from the Wall Street Journal that fake job postings are becoming a real problem. 1 in 5 jobs advertised as fake or not filled, according to new analysis, which is more soul crushing than ever. Okay, and you see on the screen right here that in April 22, according to the Fred index here, 12 million jobs were on the line, and then over the course of time, we're down to 8.1 jobs. Okay, so because and here's why this happens, guys. He's explained this happens because let's say because now of the invent of job boards, Indeed, ZipRecruiter. Again, these are methods going back decades. Okay, decades ago there wasn't Indeed.com or ZipRecruiter and all LinkedIn, right? And so what happens is if you're a local restaurant and you're in Phoenix, Arizona, and you're hiring for, let's say, a server, well, because of the way that job boards act, sometimes they will post that job in multiple different cities or even states, even though that job cannot be remote. You can't hire someone in New Mexico to be a server at a restaurant in Phoenix. They have to be there. And so that job posting in Phoenix counts as one. The job posting in Albuquerque counts as another one. The job posting in Tucson counts as a third one, Arizona, right? And so that makes it look like there are more jobs need to be filled than truly there really are. So hopefully that makes sense. This is interesting. I mean, to me, fascinating stuff, guys, okay? And because of that, you see the labor market forecast, the unemployment rate is at 4.1 on the forecast when he is arguing because of these overstatement of jobs in and of itself for the most part. You're looking at a 4.5 to 4.6% unemployment rate, making it higher. So you have inflation coming down lower than what they are stating, which is good. You have unemployment rate going higher than what they're stating, which is not so good. Okay, that's that. Then you have the Fed's dot plot for 2025. Now we're going to transition from the labor market to the Federal Reserve. What do they think about what's going to happen in 2025, guys? Because Federal Reserve rate cuts matter, right? They get to control what the monetary policy is to an extent because of how they do or how they increase or decrease or maintain the same federal funds interest rate, right? Well, here are dots. They keep it anonymous of all the different Fed chairs. You have 10 here. You have 11, 12, 13, 14, 15, 16, 17, 18, 19 Fed chairs across America. And you can see that the predictions of these Fed chairs are for the dots include, which ones believe the target federal funds rate will be at come the end of 2025. Right now, the federal funds rate is at current 4.375. One Federal Reserve member believes it's going to stay the same, and there should be no rate cuts in 2025. Just one. 3 believe there should be one rate cut. These are all 25 basis points cuts, right? Okay. And 10 believe there should be 2 for a 50%, or 50, I should say, basis cut in the federal funds rate. And then 3 with believe that should be actually 3 cuts, 1, 4 cuts, and 1 actually 5 cuts, which is pretty wild, right? So if you go with the 10 members, you can see right now that they believe there should be a 50 basis points cut in 2025, 2 cuts in general, and that's most likely to happen. All right. Well, where could mortgage rates go with that all being said? This is interesting as a 10-year Treasury chart. Okay. And in this 10-year Treasury chart, you'll see that it goes between 3.6 to 3.8 in terms of where the target usually is. That's the target that they're trying to achieve, the Federal Reserve. Okay. You get the 10-year Treasury to 3.6 to 3.8, but there is a spread in mortgage rates. Okay. There is a spread in mortgage rates, and that spread is usually between 1.6 traditionally, okay, 1.6 to 2%. Now, I know it's a lot of numbers I'm throwing at you guys, but stay with me. The spread above the 10-year Treasury is usually 1.6 to 2%. That's the spread. That's how people make money on the borrowing cost for mortgage rates, right? Okay. Well, right now, the spread is about 2.75% above where the Treasury yield is, okay? But again, traditionally speaking, it usually fluctuates between 1.6 and 2%. So it's much higher right now, which indicates that if the Fed keeps it where it's at or even drops the federal funds rate, that spread will have to come down back to the mean, revert back to the mean, so to speak, and be between that 1.6 to 2% rate of the spread. Well, what if we be more conservative? What if we say we're just going to, be between where it's at right now and where it could be at 2%? We cut it somewhere in the middle, and we wouldn't go even more conservative to 2.25%. And what he argues is if you get a 2.25% on the spread, which is still higher than what it normally traditionally is, you could see the 30-year mortgage actually be at 5.85% to 6.05% in 2025, guys. So listen to me closely, please. A lot of people are going to get on on YouTube, on podcasts, on TV and say, you know what? I think my prediction is going to be that rates have to come down because affordability is just too much. And because of that, or too high. And because of that, I think it's going to be around 6%. And they might be right. They could be right at the end of the day, at the end of the year, 2025. But this is data scientifically as to why we believe it is going to, I'm on the same bandwagon as Barry Habib, why it's going to get possibly down to 5.85% to 6.05%. These are technical data points that can't be ignored. Target low would be the high fives, low sixes. Okay, that is good. It makes affordability better for all Americans. Okay, now from there, you can see the chart backing that up. Here is where we're currently standing. I'm sorry, we're not at 2.75 currently. We're at 2.5 as of last week percent currently on the spread. And if you just cut that in half, you're at 2.25% being very conservative. But I think it's below 2.25 and down around the 1.62% spread, given where the Fed says they want the federal funds rate to be. You could be looking at a rate around 5 3/4, guys. How great would that be for affordability in America? But these are the technical aspects of proving the point. Okay. Now, and look at the U.S. housing market. Okay. We're going to pivot from rates to the U.S. housing market in general. This is fascinating data, guys. Fascinating. Why? Look at this. A total of households in America right now, households, 136 million households in America today. Out of that, 45 million of them rent, 91 million own. And of the people who own real estate in America, there's a total equity of $37 trillion. Wow. People who rent real estate in America, their total equity is zero, because they don't have any equity. They don't own real estate. So that right there is a good chart to look at as a great argument to own real estate somewhere, no matter where you are. And if you're in Phoenix, that's a great place to own it, in my humble opinion. But a great place to own real estate and start building wealth over the long term. But again, it takes a while to do that. Now, the average per household, $407,000 of equity throughout America, $407,000 average throughout America, each household. Okay, free and clear, 35 million of those 91 people who own 35 million own their house free and clear and have a total of $20 trillion of equity, and 56 million have some sort of mortgage on their house, and they have a total of $17.3 trillion. Averages out per household, $571,000 of equity for somebody who owns their house free and clear throughout America. And if you have a mortgage, $311,000 of equity that, if you were to sell today, goes right to your pocket, unless you have, of course, fees or taxes to pay. Okay, now that's fascinating to me, in my opinion. Okay, now demographics. I love he said this. Demographics is destiny, and I'm gonna steal it from him because it's so true. I believe that's very true. Okay, look at this, guys. The boomer generation. You see the ages. You see the population. The current rate of home ownership, and the home ownership rate when they were 30 and when they were 40. Interesting, right? Gen X, I just made the tail end of that one, unfortunately. I'm in the Gen X, 65 million population. When they were 30, 42, a little bit less than the boomer generation. And when they were 40, 59, a little bit less than the boomer generation as well. The millennials, okay, 73 million, the biggest population of all, 45% current home ownership rate when they were 30. Well, some of them are there, some of them are not just quite yet, but 33% is where we currently stand. And then they are targeted to be at 55%, up about 22% by the time the millennials are age 40. Okay, Gen Z, only 8% because they're pretty young, but what will that be like in the future? Well, you can see right here in the data, guys, that the millennial, 73 million minus the median age of 35, equals homeowner rate of 45%. Millennials with a median age of 30, okay, there's 40 million total of those people. Home ownership rate is 33%. The next 10 years, the home ownership rate, here's the point, should rise from 33% to 55%, or 8.5 million more homeowners. That's just the millennials, right? By the time they're 40 in 10 years, okay? Gen Z, home ownership rate is 8%. The next 10 years, the home ownership rate should increase from 8% to 33%. Okay. They won't be 40 yet, but they're going to be getting there, right? 25% more, or 17 million more homeowners than above the different before generations. Okay. Now, if you take those two together, let's see, 17 plus 8 would be 25.5 million. But then you say, wait, hold on, Kelly. Not every single one of those people are going to necessarily buy a house each. They will probably form a household, husband and wife, they'll get married, whatever, right? Yes, you're right. You're exactly right. So let's just be conservative on that. So we'll say 19 million homes. 25.5 is slated to be created in terms of households. Let's go with 19 household formations over the next 10 years. We divide 19 divided by 10. That's 1.9 million households to be formed in America each year for the next 10 years. Okay, 1.9 households. That's pretty conservative because you could go 23 million, 22 million, something a little bit closer to 25.5 million. Okay, but 1.9 million per year. All right, that's the demand of people who need to buy houses, someplace to live, call home. And again, we're already factoring in the people who will rent because we're going back all the data throughout the last several generations. Okay, housing starts between 1.3 and 1.6 according to Fred here, right? Okay, new privately owned housing unit starts. Okay, you can see it is fluctuated. I mean, well below a million here, right? Well below a million. Okay, and then of course back in 2020 because of COVID, and then it spiked up, and then we've been operating within this yellow optimal area for quite some time. That's where we want to be, but we've been out of it for a little while too, where we really have more supply in 22, which is good. We need it. We're behind in supply. But on average, 1.49 million homeowners or household starts on average over the past 5 years, 2020 through 2024, the end of. Okay. Now, let's go pause on a second. Guys, just that alone. I'm going to show you that screen in a second, but just that alone. If you have 1.9 million households forming that want to buy homes, and you only are creating 1.49 on average new housing starts, new houses, you have a housing supply shortage of about 400,000 homes per year across America. If you have a shortage of supply, according to demand that we see coming down the pike, is that going to make prices increase or decrease? Okay, let me share my screen. Just chew on that for a second. Let me share my screen. Active listings. This takes everything into consideration right here, right? So someone says, okay, well, hold on. We have a lot of supply right now. And that is true. It's been increasing, especially here lately. Even in Phoenix, we're seeing this, right? That's why the Cromford Market Index is going more towards a buyer's market. We see a 27%, in fact, increase of supply from in 2024, for the most part. 27% year over year from last January to this January, increase of supply. That's good, right? So that's going to keep prices coming down. Well, in the short term, maybe a little bit across certain markets of America. But check this out, guys. The population over the course of since 2018 has grown 12 million more people. And prior to COVID, the average amount of housing inventory for active listings fluctuated between, right here, this yellow area, between a 1.1 million and 1.3 million, it's called, right here. And since then, even though we had an increase of 27% of active listings this past year alone, we still have an overall red line here decrease in supply of 21% since 2018. Yet we had a population increase on that same period of time of 12 million more people in America. Again, I ask you, does that bode well for housing prices coming down or going up? It's just demographics. It's just data. Okay. So now go to the next one here. Seasonal opportunities. This is from the Case-Shiller Home Index. It shows across America what prices do during seasons, different months of the calendar year. You can see, guys, January, not much of a dip here in 2022, a smidge, slowed down for just a smidge. 2023, a dip. 2024, January, a dip. What will it do in 2025? You can already see that from September and October, the data start going down. And we know in Phoenix that this 100% took place, and it dipped dramatically in November and December of 2024, and that we will hopefully see an increase, as we usually do, towards the end of January, right about now, into February, as we are actually starting to see that in terms of listings going under contract, demand increasing. We just saw it because we showed you the amount from January to January last year alone is up 5.6% here in Phoenix. Okay. So could this be an opportunity? We are still in January right here in Phoenix. Could there be a buying opportunity? Because you can see the seasonal cycle of the housing market doesn't go down as the springtime increases. If anything, it goes up, and it goes up almost every single year like clockwork like this. So the best buying opportunity year over year is going to be that December, January timeframe. And this just proves the point, guys. Okay. Now, last but not least, so what does this all conclude for our 2025 MBS highway forecast, which is Barry Habib's company? Okay. Give all the credit to Barry Habib on this. He is the genius behind all these slides. I'm just present it to you because you didn't have the good fortune to sit in the exclusive mastermind, if you will, with Barry presenting. Okay. But here you go. You're getting the goods, guys. 2025 MBS highway forecast. Here we go. Unemployment rate will actually be higher than forecasted to 4.5 to 4.6% from 4.1% forecasted. Okay. Core PCA inflation will actually be lower. Okay. And it'll go down to 2.1%, maybe anywhere from there to 2.3% from 2.8% where it currently stands. Remember, what's the Fed's target rate? They always say 2% for inflation. Well, we're probably going to get there by the end of 2025, according to the data and demographics. Federal funds rate, 3.25% from a 4.375% right now. Again, most of the Fed chairs believe 2 to 3 cuts are in order in 2025. And therefore, that would bring the federal funds rate down to this range, which is darn near a full point, right? From where it's currently at. Okay, not quite, but in some cases it is based on this range. And then mortgage rates, target low, high 5s to low 6s from 7%, guys. A full percentage point or close there to by the end of 2025, guys. 1 percentage point will make a huge difference for most people looking to buy a house. Okay. And I'm going to prove it to you right now. Okay. Now, before I leave and we end this thing here, guys. Okay. Check this out. This is the media. Okay. Now I'm going to speak to you right now. Okay. This is so good, but I can't give the goods away. Let me get, all right. Some of you may recognize that lady. Okay. Okay. But you're going to look at this face really quick for a couple seconds. All right. Her name is Diana Olick and she's with CNBC. Okay. The media will tell you one thing, the general media, and a lot of people listen. And unfortunately, you don't get your predictions, your advice, or your advisement from people giving you data. Now, I'm going to get some haters on here that say, well, you're just a real estate agent. This is self-serving to you. But, and maybe so. But guys, I'm still giving you the data. It just happens to work out in my favor because I'm someone who sells houses and I believe in the dream of home ownership in America. All right. And what it can do to you from a wealth building financial standpoint. I've been someone who's done that and experienced it. Okay. But watch what the media does here. These are real facts, real data, live and raw. Here we go. This is Diana Olick right here from CNBC. Existing home sales, right? She always talks on existing home sales and housing bubble fears. Okay. Here's what she's been saying. And Barry pulled this out of the archives. So credit to him for all this. Okay. October 15th. Now he did it one bullet, so you couldn't cheat. Don't look ahead. Stick with me here. Okay. October 15th, Housing Today, a bubble larger than 2006 in October of 2015. In other words, a bubble huge, don't buy. What did it do? In 2015, went from 400K to 420, 5% increase right here. Next one, August 2016, we're in a new housing bubble, she reports. What did it do? Went up another 5%. Average home, 441. November 2017, homeownership doesn't build wealth, study finds. 2017, what did it do? Went up 6% to 467 across America. Okay. 2018 is better to rent than buy in today's housing market. Just go ahead and rent because buying is too risky. What did it do in 2018? Went up another 5% to 491,000 average price point in America. July 2019, the housing market is about to shift in a bad way for buyers. What did it do in 2019? Went up another 4% to $510,000. Next year, December 2019, okay, later that same year, next year will be hard on the housing market, especially in these big cities. 19 went up 10%, $562,000 average price point. July 21, after COVID, housing boom is over as new home sales fall to pandemic low. July 21, what did it do? went up 19% to 668. March of 22, why the housing market is in increasingly big trouble. Housing market's in trouble. What did it do in 22? Went up 6% to 708. September 2023, home prices may be turning lower. Probably shouldn't buy. Goes up 6% to 750. And October 24, rising housing risk with Diana Olick. Market goes up 4%. So if you had a home that was worth $400,000 in October 2015 and did not listen to her, you would be missing out on your home value almost doubling and creating equity for yourself. That'll be real dollars in your pocket if you choose to sell of $380,000. And that's the point I want to make to you today regarding the media and being careful who you listen to when it comes to your housing market advice and overall economic advice. I am not a financial advisor. I'm not a real estate attorney. I'm not a CPA. I'm a real estate agent that dives deep and tries to surround myself with smarter people than I am so that I can then take data points they're sharing with me and actually determine if I agree with their synopsis of the outcome of these data points, or maybe it's close, but I want to tweak it a little bit, or I think something different. But I think Barry Habib hit this nail right on the head when he said this, okay? And I'm going to go and show you one more thing here, guys. We're going to go a little bit long because I think it's good, okay? I'm going to share my screen, and we're going to go down here, and I'm going to show you a couple articles. Millennials, they're desperate for affordable homes and are willing to make surprising concessions. Guys, this is not good. It's kind of sad, but it's true. These are what the surveys find, okay? We just talked about the millennial demographic in the presentation and how they will continue to buy homes. And this backs it up right here, what Barry Habib was saying, okay? Here we go. A new survey of millennials by Clever Real Estate, just 21% of millennials believe their generation can afford a home. A substantial decline from 52%, who said the same in early 2024. Additionally, 96% of respondents said they have concerns about purchasing a home, with 44% saying they are worried about finding an affordable home, up from 35%. But here's the interesting part here, guys. In fact, 57% of millennials said their desire to be a homeowner means they will be willing to purchase a home that smelled like cigarette smoke, and 41% said they would purchase a home that has asbestos in it, if they can get it. 41% also said they'd be willing to buy a house with pests in it, such as mice, cockroaches, or spiders. 40% said they would buy a house with a leaky roof, and 35% said they'd be willing to accept foundational issues, all because they want to be a home owner in America. Other findings from the survey: 74% of millennials believe high interest rates make it now a bad time to buy a home, but 76% said they'd be enticed to buy if rates were to fall in 2025. 56% would offer over asking price, though that figure is down from 79% last year. 67% regret not buying a home when prices were lower, and 32%, one more time, 67% regret not buying a home when prices were lower. Should have listened to Diana Olick from CNBC or the general legacy media. And 32% expect to max out their budgets if they try to buy this year. Last but not least, 45% think their generation faces the greatest challenges in affording homes, with 33% pointing to baby boomers as being most responsible for the nation's affordable housing crisis. Guys, I hope you just heard that loud and clear. You have a bunch of people, millennials, who want to be homeowners, but for all these other reasons say they can't be right now. They regret buying a home earlier. And yet we just showed you that if you listen to CNBC, which is a business, it's a business network, right? Reporting on a lot of things. One of those is the housing market. Their specialist, their expert says along the way from 2015 all the way to 2024, there is fear in the market and you probably shouldn't be buying, or be very, very careful if you do. And yet, what did the housing market do over those 9 years? It doubled from $400,000 to $780,000, almost doubling. Okay, so if rates come down, because right here, this survey says 74% of millennials would be willing to buy a house, even at a bad time of year, if rates were to drop in 2025. So if that many people get off the fence and go into the housing market, because Barry Habib is correct, let's say on his forecast that rates come down pretty much somewhere around a full percentage point, You guys heard me on this show say before that the data suggests that 4.5 to 5 million people are waiting on the sidelines, ready to jump into the housing market to buy if rates come down a full percentage point. And if that happens, some of that 4.5 to 5 million is millennials, because 74% of them surveyed just said they are going to jump in if rates come down. Okay, because 67% regret not buying a home earlier when prices were a little bit lower, guys. And prices probably aren't going to come down anytime soon. And if you believe what Barry's data says, you're going to see that he says overall home appreciation, don't miss this, year over year is going to be between 4 and 4.5% by the end of 2025. And if you look back at his forecast on 2024, January 24, he said between 4.5 and 5%, and it ended up being a 4.5% home appreciation year. Well, he's saying 4 to 4.5 and 25. And so if he is right on target, you're going to be right in that same ballpark of appreciation, which means home prices will not be coming down, generally speaking, across America. But your ability to buy a home being more affordable, okay, when rates come down will be something you should pay close attention to, or even potentially if you believe that buying a house before rates come down, before you get multiple offers, because right here, according to this survey, 56% of millennials would be offering over asking price, and that's down from 79% saying that they would over asking price last year. So, guys, call us. Any questions? Hope this is good information. This is not meant to be fear mongering or scare anybody, but man, I was so jazzed by hearing this information. I wanted to just give it to you guys, and as a way of saying thank you for watching our show. If you have any questions, call me at 480-660-5974, and the replay will be up on our YouTube channel, Everything Phoenix, here in just a few minutes. Thank you so much, guys, and make it a phenomenal Monday. And until next week, same bat time, same bat channel. Keep it classy, Phoenix.